Today's conversation is going to be, we'll go through a little bit of details about just my impression of the real estate market and sort of where things sit. And then I'm going to introduce Noel Bennett. He's sort of the collaborator in this conversation. Noel is a wonderful lender. He works with Cherry Creek Mortgage. I've known Noel for a very long time, and he's also very astute as to the mortgage space and also where the economy and where things are going. He studies that a lot deeper and more frequently than I do. So I think he adds a great deal to the conversation. So we won't keep you all too long, and I'll just kind of dive right in. Let me share my screen. Let's see. Do you know? Okay.
Looks great.
Perfect. So just to sort of kick things off, I think probably most people on here know who I am, but I'll just give myself a little introduction first. My name's Steve Remmert. I've been, in the real estate business for I think close to 25 years, all within Boulder County. And, in that entirety of time, I think I've probably sold, I don't know, 1,100, 1,200 houses by now. I've been pretty active in this market for a long time. So that's just a little bit about me. And then Noel Bennett, like I said, he's with Cherry Creek Mortgage, and you'll get to know him a lot better here in just a couple minutes.
Hi, everybody.
So, I'll just give my 2-second overview of where I think we are in the market. Obviously, we've come off, the pandemic market time. And it always drives me crazy when people say the pandemic's over, because we all know it's very much not. But I think a lot of the fears of the pandemic and a lot of the early reactions to it have sort of vetted itself out. And I think we're reverting back to what I think is a bit more of a normal business cycle. We've been in this tremendous period of imbalance in the market where the sellers kind of held all the cards. And, that can only last so long. And I think as a market, it's relatively unsustainable. So my impression is that we're reverting a little bit more back to the norm, and where a lot of people say the market's really cooling off right now. And that's not atypical. It's just we haven't seen it for 2 years. And this little bit of a plateau that we're hitting is not an atypical cycle. And frankly, I think it's really healthy for the market to start pointing it in the direction of balance versus being so seller favored. So that's sort of where my 10,000-foot view is going. Get this out of the way. Historically, the spring and March, April, May have historically been our very best times in the market. And that's even proven to be true for the last 2 or 3 years. And the summer, by June, July, August, really starts to cool itself down. That's not going to be an exception here. I think we're going to see that in the market right now. And we've already started to recognize that. And to me, inventory is growing a little bit. Granted, it's still down tremendously, and that's still a major part of the conversation, both locally and nationally. Numbers can be deceiving. When you see housing sales down, everyone assumes that the real estate market is crumbling. That's largely just has just been a reaction, or that statistic has just been the manifestation of the fact that there's very little to sell. So I think as we see inventory grow a little bit and days on market grow a little bit, buyers are going to feel more comfortable. and we're going to sort of revert back to a much more healthy, balanced market. This has been a really tough market for realtors. Everybody thinks that it's been nothing but roses for realtors, but when there's 30 offers on any given listing, that is not only emotionally taxing, but it's also, our efforts are compounded greatly by that paradigm. Noel, I don't know if you've seen a similar thing in your space. Can you speak to that a little bit?
Definitely, yes. I mean, first of all, you're absolutely right about the pandemic, just having had COVID last week. So I know firsthand it's not over. But yeah, I think that from the lending side, I would echo exactly what you said. We've had such, it's frankly been a very difficult period because all we see is buyers, of course, and buyers are the ones who have been having a very challenging time trying to get under contract with multiple parties making 10 plus offers and not getting under contract on any of them. And we've had to revert to offering a cash offer type of program to try to help people get under contract. I wouldn't be surprised to see that start to fade a little bit, and I think it already is. And I think that I think we do see balance, and balance. I've been longing for it as well. I just think it's good. It's healthy to have that start to come into play.
Yeah. And I think too, as we've probably all seen, sometimes we walk around our neighborhoods and are shocked at what our neighbors are asking for the houses that they're selling. And I think we're going to reach a little bit of some price elasticity where we might see some drawback. There's been quite a bit of conversation about price reductions because things are sitting, and it's not that value's being lost. It's not that the market's declining. It's just that sellers, I think, just got a little too ambitious, and the market's not quite there to support their ambition.
Mm-hmm.
But if something is priced well and presents well, there is going to be an audience. There always has been, and there always will be. It might not be 10 offers, it might be 3, but the demand, and especially given the supply chain shortages and the lack of labor. I was talking to my friends at Melton just last week, and they were saying that they could hire 10 framers right now and keep them busy, and they just can't find them. And I think that is compounding the demand for homes that are really turnkey and really done. Not a lot of people are looking to take on big projects. So again, it's getting to the point of if you're thinking about selling, really making your house present well and present as a finished product is much more important today than it has been. And the buyers are always willing to pay a premium for that. So, okay. So I will continue onward. To sellers, again, we've gone off this wave of everything selling for as much as, gosh, there was a time in South Boulder at that $1 million price point where things were selling. It was sort of standard to say 25% above asking price, and you better waive every condition or you may not get the house. We're still seeing that. We still have to be aggressive at that price point because there's so much demand. But again, it's starting to wane where we thought there would be 30 or 40 showings in any given first weekend. We're seeing 8 or 9 and still getting plenty of offers. But again, the balance of power is shifting a little bit. Noel, maybe you can speak to the rate hikes and how you're seeing that affect buyers' mentality and their sentiments.
Yeah, thank you. I was going to actually jump in there. So I think that, the biggest, I think, myth or misconception that we get on our side a lot is, hey, I'm really worried about the next Fed rate increase and mortgage rates going up 0.5% when they do that. And so I think that the reason it's a myth is the mortgage-backed security market moves in advance of what they expect to happen. And we know that a June increase in the Fed rate of 0.5% is already kind of baked in, and actually as July probably is as well. And so we've actually seen our rates trend down even the last time the Feds raised rates. So part of what we're trying to do is educate people that the fact that the Feds are raising interest rates is actually a positive for mortgage rates, because that means they're doing what they can to fight inflation. you can argue that maybe they waited a little too long to do this. And so, but that's neither here nor there at this point. But I think that it's driving like one of two things: people to feel a little panic and like they've got to buy right away. And then another side, maybe another subset of people are like, oh, I'm not going to buy right now because rates are just on their way up. And that's definitely not the case. I do think there is a bias towards rates going up in the shorter term to at least a small degree, but we can talk. I have a couple of slides coming that will probably mention, why I think in a longer term, rates may actually trend down.
Yeah. So, and then just speaking to the buyers out there where that shifts, I think this, as the market cools and as inventory increases, I think we're probably about to walk into one of the better buyer cycles that we've seen in quite a while. Granted, rates are higher, you're paying a little bit more, you're on the tail end of a ramp up in prices, but I still think buyers are going to have a little bit more options. It's almost been a take what you get mentality for the last while. And now I think buyers are going to have the opportunity to be a bit more selective. It's funny, I was with someone filling out an inspection objection just last week. And the joke was, or I guess it wasn't much of a joke, was that a month ago, we wouldn't have even had an inspection because we wouldn't have had the opportunity to do one because there'd be 5 offers that waived inspection, which is a tremendously uncomfortable thing as an agent representing a buyer. So again, reflecting on the balance of power, I think that the road ahead for buyers is better than the road behind us. And, of course, interest rates are a big part of the conversation, but again, I'm going to allow Noel to speak to that when we get to that place. Yeah.
And Steve, just one question I had for you, that it seems like, most sellers are actually buyers too, because you sell, but you're obviously typically looking for a new home to replace it. So having a more balanced market helps everyone, right? So that's positive.
Agreed. Yeah. Agreed. I mean, there are those new buyers in the market, the first-time home buyers, and frankly,
Right.
They're the ones that I have the most compassion for in this market because they haven't seen the opportunity or haven't seen the ramp up in value, and thus, they're new. But again, our next little segment is going to be talking about, are we in a bubble? And so we'll address some of that, and that largely relates to new buyers. So we're going to talk about that in a second. But just to jump into some quick statistics, and I'm not going to overload anybody with statistics, but just to reflect on where things are. This is Q1 of 22. The average sales price is up 13% year over year. That's pretty impressive in a market that we usually deliver, between 5 and 7%. The month supply inventory is up. Granted, if you look that little number on the left side, it says we've got a 0.5 month inventory. A typical balanced market is somewhere between 3 and 4 months of inventory. So we're a long way away from a balanced market. But again, looking at where we've been and that we're up 20% is pretty staggering that it's still that imbalanced. But the trend is shifting in the right direction, I believe. Days on market, you can see we're down 30%. It's 35 days in the MLS is the average days on market. That means that things are going under contract almost right away, because that 35 days is including the period from contract to closing. So, it just shows that it's been such a healthy market. And it's down, even year over year, it's down 30% from where it was. But, hopefully that's going to balance itself out. I would love to see our month supply inventory up in the 2 months type market. Percent of to list price, again, year over year, we're 4% above list price. So things on average are selling at about 105% of list price. That varies tremendously on the purchase price. Once we get into the upper thresholds of our market, it's pretty seldom that you see something selling for at or above, not completely unheard of, but But as we get, the bulk of the market sits in the middle of the market, and that's where we're really seeing that 5% above. And like I said, 2 months ago in the lower price points, we'd be talking 25% above. So again, still pointing signs to a tremendously healthy market. So, the question of are we in a bubble? And I know Noel and I were talking about this before we started this conversation. Two things that I think are important to recognize is that real estate's always been a healthy hedge against inflation. And it's always proven, or at least it's historically proven, to be a fairly safe harbor during these times. So, if there's ever a time to look at real estate as a holding place for some money, now is not the worst of times. I'm pretty emphatic that we are not pointed towards a bubble. If you were to listen to the news, sometimes they would probably tell you differently. But again, it's this negative news cycle that they just want to report some alarmist mentality. But if we were to look at our supply to demand ratio, it's still tremendously in balance. In fact, it's even favoring a healthy market. Sellers are wealthier than they've ever been. They've got more equity in their homes than they've ever been. And if you contrast that to 2008, 9, 10, when it was driven by the seller's lack of equity in houses, that is a variable. We're about as healthy as it can be. Then if you were also look at new home starts, are down tremendously. And, the market tends to react to things like, and I'm talking the stock markets tend to react negatively to new home starts. But if you look at what that does to the pressure on existing homes, it only pushes up existing homes because the availability of housing starts to get more slim. And then, Noel and I were talking about how it's really hard to look at real estate as a national market. You almost have to look at it as a local market, but there's so much. We've probably never been in a healthier job market. Of course, there's been some sectors that have been more impacted by the pandemic, but we've never been in a healthier market from a job perspective. We can't even find enough lifeguards to man our pools here locally. So all I read is that construction, tech, everybody is starved for employees.
And I might just say something on the real estate bubble, because that's a question I'm getting a lot from clients who are nervous. If they are nervous, that's one of the things they're nervous about. And so we had the seller side of the equation, but we also, of course, had a really big amount of artificial demand from people that really couldn't qualify for a mortgage in a traditional sense. And to what degree that was happening, with the benefit of hindsight now, we realize it was happening to an incredibly large degree. So we had buying demand back then in 2008, 2009, that really shouldn't have ever been there. And as you look back, it seems so obvious how that happened. And we don't have anything like that today. In fact, we have a little bit of the opposite, where people are hyper qualified for the mortgages that they are getting now. And you could argue that, like Fannie Mae and Freddie Mac they're not even quite taking on enough risk. There's a certain level of risk that they're supposed to take on, and a certain number of defaults they can accept. And those have been running lower than really they probably should, which means there might be limiting access a little bit for especially lower end buyers, early kind of first time buyers and such. So we just don't have that piece. And we have a huge, to your point, Steve, in our area, but around the country, a huge shortage of housing. So there's a lot of demand and not enough supply, and that doesn't make for a bubble.
And it's funny, even looking local, and I'm not telling anybody on this call anything new, but you just drive around and all of a sudden we see Microsoft as an office here, and Bing and Twitter, and everyone knows about the Google expansions. And then the latest development is Blackstone's opening a life sciences division here, and I think they're buying the space and putting in about 600 million into that. That's going to bring more qualified jobs and more stability within our market. And I'd love to see the diversification of our market across all these different segments. We used to be this little hippie town that had natural products and not much tech, and short of IBM. And now all of a sudden we've got CU, IBM, tech, natural products. We have become a much more diverse and healthy job market. And I love seeing all these little, new signs that we've recognized, they're all the biggest companies in the world, and they're setting up satellite offices here in Boulder.
Yeah.
Of course, Boulder, talking about the tech startup culture, Boulder continues to rank high as one of the best places to live. One of the interesting paradigms is that what we saw was, and of course, probably 50% of my calls are people from San Francisco or LA that are looking to relocate to this market. And now with the balance of power between the employee, employer, and the employee having more power, I don't know how rapidly or if we'll ever return to the same workplace that we've seen recently. And these lifestyle communities like Boulder are going to continue to be attractive, because there's an awful lot of people that are saying, I'm never going to go back to the office, so why would I live in New York, San Francisco, or LA? So that, largely that was our pandemic bump, where people like that saying, I'm making a shift for quality of life. And I don't see that ending anytime soon. We'll see, how, if New York starts calling everybody back, but I don't think that's going to be the case. And I think we're just going to continue to see migration to these more inland or more tax friendly and lifestyle friendly markets. Yeah, that's it. Noah, you could probably speak to that too, that where are your new applicants coming from?
Yeah, a lot of Californians for sure, Chicagoans, and East Coast types. And I think exactly tracks with what you're saying. They so many people, and I know this because for our loan approval process, when someone's moving here, but they have an employer, say, based in New York City or whatever, San Francisco, one of the things we have to do is get a letter from the employer that they are authorized or able to work remotely with their job without any impact to their income or job title. And so we're getting those letters all the time. So I think it really proved the point that the people are making this choice, a lot of these people, and frankly, Boulder I don't think it looks very expensive to some people coming from San Francisco and such crazily. So yeah, I think that there are those types that are just now making a lifestyle choice because they can, and their jobs are willing to let them do that. So I'm seeing it all the time.
And it's funny, historically, people have moved to these more lifestyle driven communities and made sacrifices in pay. Right. And now that's simply not the case. They can get New York City or San Francisco pay scale,
right,
and live in Boulder. And to your point, the housing market looks cheaper relative to their income. The AMI of our market, the average median income, has always lagged our home sale price. And I've always wondered how that can exist for, how long that can exist. And I think that now that we are a national workforce located in a small local market, I think it further supports that.
Correct. I agree.
Yeah. Let's see. I think we've talked about most of this stuff, but Noel, this is probably a good time for you to chime in.
Yeah, perfect. So, one of the things that we talked a little bit as we were getting ready here is, I think about two big variables when someone's buying a home. And this is how I try to think about when I'm talking to a new client that's considering purchasing. This is whether it be a first-time buyer or a repeat buyer. And the variables for me are always, obviously there are other ones, but purchase price and interest rates. And so I get a lot of people like, oh, I think I'm just going to pull back. Not a lot, but certain group of people are going to pull back and wait till interest rates go down and prices correct. And that's something you hear a lot. And we've already talked about the idea of a bubble, or the fact that I in no way think we're in any sort of bubble. Furthermore, I don't even think we're in a place where, as we do believe, appreciation is going to slow down, but it's not going to reverse and we're going to start seeing prices decline, especially in our area. So the variable of waiting and holding off on purchasing for prices to stabilize or drop, I don't like that one so much for people. I think that you can remove that big variable by, if there's the right home for you, buying now. And then the interest rate is the other variable. And we know that rates are up. There's no question, obviously, but they're up from like a point that just historic lows that we only saw because of a black swan event in COVID and the pandemic. And so while we are up, over the last 10 years, we're toward the higher end of the scale over the last 10 years, we're still historically in a pretty good spot for interest rates. So, people can secure and lock down one of the variables in purchase price. They can also lock down the variable of interest rate at still a decent rate, not as good as we would like, but there's always the opportunity to refinance. And, I don't know if we want to jump into the recession idea right now, but, I think that we are we're coming up for a recession, and there's a lot of indicators, and most people have come around. The guy that I follow, I was telling Steve, does a deep dive analysis every morning of the MBS or mortgage-backed security market and the bond market, and how he has been seeing recession since kind of November. And now everyone's kind of caught on to this. Even the Fed speak is starting to talk about what they call not being able to achieve a soft landing. When they're talking about that, they're talking about the fact that we're probably going to hit a recession. And you can see when they raise rates, they always go a little too far. It's impossible almost not to, and put us into recession. But that's a great time to take the variable of interest rate and take where you are now and hopefully ratchet it down into a lower interest rate and a lower mortgage payment.
Yeah.
Is there a slide coming up about just a couple of those recession pieces? Yeah, so we can see, this is one of the indicators that Barry Habib, who I follow, has been looking at, and just, blaring this trumpet off over and over. But you can see that the Fed funds interest rate, those darker gray bands are recessions. And you can see leading into basically every one of them, we were kind of getting to the high point of where the Feds, they were raising rates, and it always kind of brings us back into recession. And so this year, this time right now is no exception. We're back in it. It kind of goes off the chart here at the far right, but that we're in a period of rising interest rates, and the Feds they just basically tap the brakes too hard on the economy, and it's very hard for them not to do that. And maybe you can flip to oops. So, So, was there one right before this, Steve, or is this the next one?
There we go.
Okay, yeah. So, talking about unemployment, well, people say, well, how can we be head into recession when our unemployment rate is so low? This chart's very interesting. These dark blue bands are all recession times, and you can see we're always right near the low point of unemployment right before we head into recession. There's a couple really complicated reasons why. I found it very interesting, but just to the larger point, you can see that, right now on the very far right, we're headed towards very low employment, or that's where we are. And you can see every other time we have entered into recession. So there's a lot of indicators. It's not guaranteed, nothing is, of course, but it would be hard to imagine how we don't find ourselves in a recession in next 12, maybe it's 18 months. That's harder to predict, of course. The average would say it actually should be sooner, could be in the next 6 months. And then maybe Steve, bounce to that next one if you could. So this is what I'm having to answer or think through a lot with clients. If we go into recession and we buy now, all of a sudden prices are going to be down for houses. But that is not at all the case. You can see that all these dark bands, and there's one exception I put a red arrow by, and we'll go through that in a second, but all the others, we have done very well through recession on these housing prices. Some of them kind of flattened out a little bit and such, but you can see through this whole time period, it's generally been an uptrend. The outlier, the exception, which is a big one, was the 2008 housing crisis. And that was an unusual recession because the housing market actually led us into that recession. And it was, again, now that we know this, it was due to very lax lending standards, creating artificial demand. And that was just by the way, our market, Steve, you can probably talk about this. Our market still here locally didn't suffer too bad. We kind of saw flattening. We saw maybe a few pockets with declining prices, but nothing like a Las Vegas or a Miami or a Phoenix where they saw these huge drops, you know. But then once we recovered from that, you know, you can see right up through the last recession in 20, we just chugged right along through that. So recessions can be rather housing friendly. And on top of that, you've got favorable mortgage rates. So it can be a great time to look at a possible refinance. And that's what I'm watching for clients right now carefully on my side is, are we having them pay a lot of points to get into their current mortgage and buying their interest rate down? I don't like that idea right now, because we do believe there could be a time to refinance. So try to keep the cost low on the acquisition of this purchase mortgage here.
Makes sense.
Yeah.
Yeah. And you're 100% right. Reflecting back on the 08, 09, 10 market, you know, we did see, I think our values here in Boulder, and again, it exacerbates the point that you just can't look at the national housing market and think locally.
Right.
You know, during that time, I would say that values in certain price points actually went up. You know, the biggest loser in that time was the luxury market. The higher the price point, the more it struggled a little bit. But
and maybe second homes too, right? Mountain properties like Vail, and that, so they suffered a little bit, I think, too.
Mountain properties got killed. They're the first ones to go when recessions hit. But that being said, it felt so short-lived, and the recovery was so rapid after the recession that we surpassed our pre-recession pricing. It felt like within months.
Right. It was a blip on the radar in our minds, and it really was statistically too. Yeah.
So this Case-Shiller graph, yes, it's representative of the national market, but our experience played out very different. We were impacted, but it was a speed bump, not a stop sign.
Right.
Yeah.
Yeah. You saw some markets, Las Vegas and Phoenix, but the thing about that is they had these huge run-ups in pricing that were not sustainable, and thus there was a bubble in some of those local markets, you know, and that's what dragged that chart down there, or that line, I should say, if you look at it.
Yeah. Okay. Well, that's, you know, honestly, that's about all we have to share with you guys. If anybody has questions, but before we jump into questions, I'm just going to share we always do a little, a charity partner on these. And this week, you know, given the context of everything that's gone on, we chose it's called NAMI, N-A-M-I. We had to do a little research to find them, but it deals with mental illness and people being affected by mental illness. And it's advocacy, education, and support. So we here are going to make a contribution. Feel free to scan your QR code if you're compelled to donate $100 or whatever you feel like donating. And I'll leave this screen on while we open it up for questions if anybody has any. And feel free to unmute yourself if you do.
Hey, Steve, it's Gil. I got a quick question.
Yeah.
I heard you say earlier that like the market tends to, and it's probably true across the country, but things start to slow down a little June, July, August.
Yep.
Which if you go backwards and you say, okay, if there's even a short like 30-day closing, maybe, you know, you're going under contract in May, which maybe means your house went on the market late March, early April, or something like that. Since we don't really start spring here until like the middle of May, putting like your house on the market in March, April, do you potentially lose any value? Because if your house shows really well with landscaping, there's not a lot going on with our yards in March and April here.
Yeah, a really good question. And, you know, the answer is that, you know, there's a positive and negative to anything. There's no denying that our demand, the greatest buyer activity, is always March, April, May. You know, our peak closing month is right in the middle of June, and it's like a bell curve. You know, you can see June is our peak, January is our valley, and it literally looks like a bell curve. So you have to ask yourself the question, Do you wait until your house is the prettiest, or do you capitalize when the market is the best? I would make the argument that nobody's yard looks great in that window. So I'm a little bit more in the camp of go on when you know the market is the strongest. But there is, for example, if I had someone selling in the mountains, I might delay that a little bit because of snow and because of just the seasonal change. But here in Boulder, I think I would in town, I think I would probably lean towards, April as an ideal list date, just because I know that our audience is probably, 10 times, 8 times greater during that window than in August. So
Okay.
that would be but there's an argument for both, and I can't deny that.
Yeah. I mean, that's kind of, for us, it's kind of key. And then just one other quick question on, and probably a stupid question, but I'm always curious, like how, because it seems like when people set prices of their homes that they're looking at this, how much, stock should we put in Zillow estimates, or what they call Zestimates in homes?
Great question. And the answer is none. It's funny, like all Zillow is an algorithm. So they're just taking your square footage and comparing it to those houses that have sold around you. They have no idea about your view. I know that you've done a beautiful renovation of your house. They have no idea of that renovation. So it's really just algorithmic. And, the greatest illustration of that is Zillow itself. They used their algorithms and bought a whole ton of properties, and it turns out they were way off, and it created a little bit of a sinking ship for them.
And the CEO sale.
Yeah, I heard about that.
Yeah, and the CEO sold his house. It was tremendously off in value on his own residence. So I wouldn't place much value in what Zillow has to say. If we were in a tremendously homogeneous community, let's say we were in the middle of Las Vegas in one of those communities with 5,000 houses that all were built in the same snapshot of time and had similar finish, I think Zillow would be a tremendously accurate depiction of value. But in our market that's evolved over the span of 125 years, it's next to impossible for them to say with even 20% range what your house might be worth.
Okay. Yeah, it just seems so, like, not just even in this market, but anywhere you look and you see homes, and almost without fail, like 9 out of 10, they're listed anywhere from 5 to 10% above this estimate. It's just like, just boom. It's just like they look at this estimate, add 5 or 10% on. That's the listing price.
Yeah. And I've seen people put merit in Zillow, and I've gone to them and I said, you're 40% off. Usually Zillow being low. I've said, you're as much as 40% off, and that's been proven right. And it's simply because of the intangibles that Zillow can't recognize.
Right. All right. Thanks.
Yeah, of course. Thanks, Gil. Unless anybody else has any questions, we are that's all I've got to say.
Hey, Steve, I think I see one in there. Could you comment on all the discount brokerages we see?
Oh, that's a great question. Well, I mean, it's funny, since I've been doing this, there have been many, many discount brokerages that have come on and off the radar in Boulder. We're not really seeing that. I mean, frankly, I can almost not think of any in this market. And I think the reason that people go to a realtor is for their experience, for their knowledge, for their assistance. And, just the idea of the idea of going to a true discount brokerage where all you're really getting is someone to shuffle the paperwork. I've seen that cost sellers tremendously. And, usually, frankly, I just don't feel that bad for them because they're the ones that chose to save a nickel, but lost a dime.
Yeah, I mean, just as from the lending side, I'll offer, I see it because I see both agents involved. And when there is a discount brokerage, and like you said, Steve, I don't really see it too much in this current day and age, but it's just amazing the lack of support and responsiveness that you can get from a discount broker. And you really do get what you pay for. And probably a little bit like the Zillow philosophy, when you're dealing with a eclectic and just a wide variety of properties that we have in our kind of market, you need that expertise of someone who knows the market, or you could be leaving a ton on the table.
Yeah. Yeah. And there have been many that have tried to make a stab in our market. And maybe a discount brokerage would be more applicable to a market like a Las Vegas, where there's a lot of homogeneity in the product. But there have been several that have made stabs at our market, and they just never gain traction, simply because I think that the market recognizes that there's value in what a true professional offers.
Right.
And exposure. I mean, you could look at a company like a Compass and say that our reach is not only nationally but globally. And there's a lot of money that, there's a lot of reasons why that helps the clients. So yeah, I've never felt threatened by the discount brokerage. And frankly, if someone wants to work with one, I encourage it, because I recognize that they're probably not the kind of client that I can help.
That's helpful. Thank you.
All right. Well, again, thank you, everybody. Thank you, especially to Jesse and Caroline, who helped on the technical side and organize all of this. And then especially to Noel for being a part of the conversation. I've always appreciated his perspective and his professionalism. So again, if anybody's looking for assistance, feel free to reach out to myself or to Noel directly, and feel free to reach out to me if you've got my contact and would like Noel's contact. I'm happy to make that introduction. But again,
Thank you for letting me be part of this. Really, it's
Yeah.
really fun, and I love thinking about these kind of things. So it's awesome.
Yeah. Well, thank you. And that's about it. So everybody, I hope you have a great weekend, and thanks for being here. It's truly an honor that people show up to listen to this. So I appreciate it very much.
Thank you, Steve. Thank you, Noel.
Bye.
Thank you. Bye.
Bye, everybody.